Good evening, everyone. Welcome to one more webinar as part of this series of sessions we are having during this COVID time. Again, to introduce myself, a majority of you know already, but I am Kishore Ramaraju. I'm an IT consultant with over 20 plus years of experience. I'm also a financial consultant. So in case if you need anything related to investment diversification, real estate, stocks, kids college savings, you can approach me. I'm also a founder of Indian Desi Friends Group, which got over 30,000 members in 30 plus cities in USA. We have our groups now in Mexico, Canada, UK, and other countries also now. One thing, as I always mention, right, sharing information is one of my passions. So I I used to create a lot of blogs, a lot of write knowledge sharing articles, and in the same way, I organized over 200 plus webinars and seminars in last 2 plus years related to all different fields. Nearly last 2 to 3 weeks, we had more than 11 webinars. Actually, it increased now. We did over 15 to 16 webinars in last 3 weeks because we know wherever you see, we have everywhere negativity or lot of fake messages. I thought like instead of thinking about something which is not useful to anyone, let's spend this time try to get information from subject matter experts, try to use that time in an effective way. We had webinars on different type of kids education aspects, right? How to get into SAT, ACT, what are those elite colleges, how to get into elite college admissions, what are those AP courses, uh, and then we had different meditation related sessions. We had different sessions on agile methodology, why, how to get into Scrum certifications, what is this Python, data science with Python. We had one session with a 12-year-old data scientist. So we are doing a lot of webinars, and we have a lot more webinars in pipeline. So on this Sunday morning 9 CST, take charge of your mind. It will be a great webinar, don't miss it. We already did one webinar where over 400 people joined, and we got a lot of appreciation. Mr. Mohan Naidu, one of the top speakers, one of the experts in this area, he will be talking about how to control our mind so that we are not thinking negative, keep focus, be positive in this time. So don't miss that session. And then we have another session on options trading. We have a session on 423 on how to improve the strength of high school curriculum. Then on 425, we have a webinar on advanced concepts of Bitcoin. Then another, I am talking to SME on Forex trading. In case if you want any other topics, please email me on kishore.ramaraju@gmail.com, or you can message me on my phone number 832-867-8808. Now it's time to invite our guest speaker today, Mr. Mahesh Pabba from Dallas. Thanks, Mahesh, for taking time to educate our members, our community about, is it right time to refinance? Is it right time to buy a new home? So we have this all these groups, and lot of members asked me that question, like, is it a good time, or should we postpone to buy a new house, or is it good time to refinance because of all the Fed cuts, all those things. So then I thought about Mahesh, who got over 7 plus years of experience in Texas real estate. He got residential mortgage origination for 5 plus years experience in Texas. He can do commercial mortgage origination in all the states. So he's an expert. He did a lot of sessions earlier. So it's my pleasure to invite Mahesh. And as we do always, so Mahesh will start with his presentation. If you have any questions, you can always put in the chat window, and either I will be asking those questions, or I will unmute each of you. If you use the raise hand option, I can unmute you and you can ask your questions. Welcome, Mahesh Garu. It's all yours.
Yeah, thank you, Kishore Garu. Thank you for having me. I'm glad I'm able to, talk to you all this Friday evening, and hope everyone is staying home and, you know, is following the social distancing, So can you hear me okay, Kishore Garu?
Yeah, Mahesh
Yeah,
Garu.
good. Glad to hear. All right. So I will share. So in general, what I want to do is, probably talk like 10, 15 minutes in general about the market and what we can offer. And then we can open up for the Q&A. Or if you have any questions in between, I want it to be as interactive as possible so that, I'm not the only one who keeps talking, but yeah, you can, post the questions or, ask any questions even while the session is going on. In that way, we can make it interesting, and uh, I will try to cover all the points that which I frequently get. So, and on top of that, if any of you have specific questions very particular to your scenario, we can take it offline. But if not, we can discuss in general. Okay? So let me share my screen or my.
Yeah, we can see now.
Okay. Perfect. And brief details about me, which Kishore will, discuss. So, I mean, again, let's see. Yeah. So my main thought process was, we'll mainly focus on the mortgages in this session, but we can generally, briefly talk about the real estate market. Again, most of, you probably know that real estate is always local, and the location is the key. But in general, what we have observed in the last 1 to 2 months is market pretty much is in a standstill. It's something, no one expected, I guess, uh, and market pretty much. I mean, we have not seen transactions in the last 4 to 6 weeks, I would say. Anything which was in pipeline, they all closed, going through the process of closing. But all the new showings, pretty much they came down to like, I would say 5%, less than 5% showings as well. So again, the question is, will the market go down, or what are the pricing? How are the pricing will be? It's again anyone's guess, I guess, at this point. And honestly, I don't know how long this lockdown is going to get extended. I'm guessing it will be at least another couple months. So market is going to be in a standstill mode for at least for the next couple months to a couple quarters, I would say. But maybe slowly, once these vaccination or some kind of uh, treatment plan available for the COVID, I think that's when we will start seeing little bit movement. But at this point, it sounds like market is going to be extremely uh, quiet for the next 1 to 2 quarters. That's what I'm guessing. And in general, yes, rates might get corrected, 5 or 10%. That's what I'm guessing. But in Texas, right? In what we have observed, even during the last downturn, Texas did not uh, have a huge correction when compared to the other markets like California or Florida or Nevada, where the prices went up and boom and bust cycle was huge. But Texas in general, my experience says that rates, I mean prices will get impacted, but not like any other state. Texas is considered a stable market when compared to other markets. So, and also the economy in general is good. It's more diversified when compared to uh, other parts of the country, I would say. So, if someone, even in this market, if someone is planning to buy a house where they're planning to live, they have a stable job, and they're planning to live in a house for the next 5 years at least, then if you see 5 to 10% correction, I think you can step in rather than waiting for to see if the market is going to crash. I don't think that the market will crash, or at least the real estate market will crash. But about 5 to 10% correction is normal, especially when we are seeing more than 10% of unemployment in the last just 3 weeks. So, but again, as everyone or most of the economists are expecting, it's going to be a V-shaped recovery. But I think it might be a little bit slow rather than a V-shaped recovery. But so we have to wait and see. I mean, again, that's the general answer, I would say. So just going back to the interest rate, mortgage market in general, everyone was expecting Fed will reduce the interest rates to zero and the mortgage rates will be close to zero. But that's not how things work. What happens is these lenders, they borrow money in the stock market, sell the 10-year treasuries and borrow the money and lend it for the mortgages. So there is always going to be that margin that the lenders will keep where they have to make some money to do these mortgages. So, but again, and another, that's one area where, let's say, one part of it, right? But the other part of the equation is Fed, Fed reducing the interest rates to zero doesn't mean that mortgage rates are going to be like at least in 2% range, or but that may not be possible in the near term because interest rates. The 10-year treasury notes for the interest went down. I mean, it was in like 2%, 2.5% about 1.5 years ago. But recently, the mortgage rates, from treasuries. So, okay, so going back to the treasuries, right? Treasuries were around 2.5% back in October. When at that time, the mortgage rates were around like 4.75 for 30 years and 4.25 or ish for 15 years. That was back in October. But then slowly interest rates started going down. 10-year treasuries started going down, and we saw mortgage interest rates slowly going down too, in tandem. But then suddenly with this coronavirus, right, interest rates, we saw that the 10-year treasuries dropped to close to like, I think 0.6% for 10 years. But then Fed came out and said that, hey, we are reducing the overnight interest rates to 0 to 0.25% on March 13th. That's when the interest, then the market realized, when Fed is going to pump the market with huge stimulus, like, QE of like $2 trillion, and then market realized in the long run, there is going to be huge inflation, right? So we can't have these rates, mortgage, the 10-year treasuries at these low rates. So that's when we mortgage lenders, the rates started going up. The volume for the refinances went up quite a bit, and then we saw interest rates in general going up. So, but again, it just happened in, based on, everyone was expecting it went against their thought process, and then rates started going up. So that's the reason, again, I want to talk about in general, when do you want to refinance? What exactly you want to do? Do you need to do a refinance or not? So that's what you need to focus on. I mean, it's more as a rule of thumb, I would say anyone who bought a house and refinanced in the last 1.5 years are good candidates to do a refinance now, because they probably got the mortgages in 4% range, and then they paid mortgage insurance at a higher premium rates. Those people will be better candidates to refinance now when they are seeing better interest rates and mortgage insurance rates. Just to go back on that mortgage insurance point, right? in the past, the foreclosure rates were higher throughout the country, so mortgage insurance premiums were at the high end almost about 2 years ago. Until that point, but then foreclosures started slowly going down, and then mortgage insurance rates improved, and home values appreciated. So we are seeing pretty much, right now we have a bottom on the mortgage insurance rates. Basically, mortgage insurance is for someone who put less than 20% uh, when they purchase the house, or when they're trying to refinance, if the market value is less than, or if their loan amount is less than, uh, if their loan amount is more than 80%, or equity is less than 20%, that's when the mortgage insurance comes into picture. But in the last 2 years, with the price appreciation, if you have more than 20% equity and you still are paying mortgage insurance, they're the right candidates to get the refinance, because the amount of premium that you pay for the mortgage insurance, you may not get a tax break, right? The amount you pay, the mortgage interest that you pay will be tax deductible, but mortgage insurance may not be. In some situations it might be, but for majority of the people, whatever the mortgage insurance premium that they pay is not tax deductible. So sometimes we try to have a option where borrowers pay for the upfront mortgage insurance, and sometimes we don't. But again, it's a personal scenario. Based on individual scenario, I can work with anyone who is uh, paying mortgage insurance and try to get them a lower payment. So one of the other reason, I mean, most people try to do is, increase their cash flow. Why do I want to? Okay, if I have to rank the reasons, I mean, what is the main reason that you want to refinance? First and foremost, I would always say interest rate. Whatever the interest rate that you are paying right now, if you are getting at least 0.25% interest rate reduction and zero closing cost, then that's the minimum that you want to look for whenever you are considering to refinance. I know in the market sometimes people say that 0.5%, or you need to have at least that. But again, that 0.5% also is a number that you want to monitor uh, only if you are paying all the closing costs. But if you are not paying any closing costs, basically if the lender credit is covering all the closing costs, then yes, even if you have 0.25% savings on the interest rate, then yes, you can consider to refinance. And so another reason people try to do is improve their cash flow. Maybe they are like 5 to 10 years into the mortgages that they took, like 30-year mortgage, and then already paid for 5 to 10 years. And once you refinance, and again, at that, in those scenarios, I would suggest going for a 15-year term, because whatever the rate, you probably have a higher interest rate paying it at 30-year amortization. And then now when you do the refinance, if you go for 15 years, it will be you will get a lower interest rate. Again, you need to have at least 0.25% savings if you are trying to refinance within the same term, but at least have more savings if you are trying to convert from 30 to 15 years. Bottom line is, look for the closing costs, because see, interest rates are highly volatile, and whenever the rates go up or down, right, whatever the money that you paid for the closing costs is going to be a waste of money, whatever you spent on that. So that's the reason it's very important for borrowers to look for, are they paying any closing costs? Is it getting added into the principal? You have to look at those things, and then decide if you want to go through the refinance process or not. So I'll go through all the products, typical products that we have for the mortgages. But So, I mean, in the recent past, I was saying, right, March 13th is when the interest rates bottomed, but since then rates went up because we are seeing unemployment increase in general. It went up quite a bit. So, uh, you know, mortgage lenders are concerned that overall, delinquencies can go up, and right now foreclosures are banned at the state, county level for the next few months. But hopefully the situation will come back and everything will go back to normal in a couple quarters, so that we don't have to worry too much about foreclosure rates increasing. But for now, someone, if they lost their job or unable to make the payments, a lot of services are offering forbearance where borrowers can defer their monthly payments for 6 months, and then basically when someone is approved for a forbearance, right, they have to pay all the payments at the end of the period. If someone got a 6-month forbearance, that means they have to make all the 6-month payments at the end of the 6-month period, not at the end of the loan repayment. And also, the one main thing that someone has to look for when they're taking the forbearance, it will be reported to the mortgage credit agencies, and then that will impact your credit score. So unless you are impacted, don't opt for that. I'm getting a lot of questions from my uh, you know uh, people I know, and previous clients, and so I always say that don't take forbearance even if you ever offered to, if you are not impacted. If you can make a payment, because once your credit is impacted, it's not easy to bring it back up. It might take, especially if someone missed their mortgage payment, it will have a huge impact on their credit score. So unless it's absolutely necessary, continue to make mortgage payments and maintain your credit score. So that's what I would say. So in general, right now, in the past, we were able to offer 30 and 15 years with zero closing costs. But now the lenders, most of them don't want to pay closing costs for 15-year term, because the margins are very low for them. But we are still seeing where we can get 30-year mortgages with 5% equity. Also, we can get refinances done with 100% of the closing costs covered by lenders. What we can say is, the closing costs are going to be about 1% if the loan amount is about 350,000. You can expect 1% closing costs for a refinance. It can be a little bit more if the loan amount is smaller. So we have to look at personal situation scenario, and then see if it's a good option to refinance. But at least, always look for minimum of a 1/4%. I know I probably repeated it already multiple times, but that's the rule of thumb that you want to follow, to have at least a 1/4% or more savings uh, to start the refinance with zero cost. The main idea is, again, to reduce the interest burden and reduce the mortgage insurance premiums that you are paying right now. And you can lock interest rates for a longer term. Um, you know, the idea is, I mean, again, if you are into investment world, you can't borrow money anywhere in the market in 3 to 4% range, not even 4, actually, in 3% range for your investment activities. If you borrow money on a brokerage account, you have to pay much more than that, right? Even if you want to borrow on credit cards or anywhere, in general, getting a mortgage a loan, cash out loan on a mortgage is, you are going to have a best interest rate option, where you can take the money out and invest in with your other investment activities. So I also get a lot of question about, do I want to pay off my mortgage or take the money and invest somewhere? See, again, if you are investing in money in real estate or stocks or you know any insurance products or anywhere that you're trying to invest, if you are making consistently like well more than what you're paying for the mortgage, then yeah, it's a no-brainer. You can take the money, home equity, and then try to invest. But if you are not doing any activities, just to be on the safe side, if you're trying to keep the money in bank account and not earning any interest, then better to reduce the interest burden by paying down the mortgage or refinancing to a lower interest rate for a 15-year term, where you can get the max interest rate reduction and interest burden reduction. So again, bottom line, if you are keeping the money in the bank and not using the money for investment activities, go for a 15-year term, pay down the mortgage quickly, have a mortgage-free, mortgage payment-free life, that you can do. But if you are investing and, as a savvy investor, and you can, uh, you know, make money in other investment activities, go for 30 years, get a 3.5% interest rate right now, where it covers all the closing cost. And uh, again, that is for a regular refinance. But cash out, in general, you have to pay closing costs. You may not be able to get a cash out loan in current situation. We were able to do cash out loans with zero closing cost about a month ago, but not right now. It's not. Uh, uh, we are not finding good options where lender credit covers all the closing costs for a cash out loan. So again, we have to evaluate the scenario and then see what are the advantages of disadvantages of doing a refinance based on someone's particular scenario. Just to give you a comparison of these rates, when we are mortgage brokers. Basically, we have a dozen different wholesale lenders where we have tie-ups with, where so we work with the borrowers, get their scenario, see which lender can offer a better rate and credit for their scenario, and then work with that particular lender to take care of the entire process, the refinance process or purchase mortgages. But just to give you some comparison of the rates about a couple of weeks ago, where if you can see that this one screenshot, I took it from Bank of America website, where you can see that they were charging 0.985% to get to offer 4% rate. So again, when you're paying points, which most of the time, if the rates go down in 6 months, you can always refinance again, as long as you're paying zero closing cost. And even after 6 months, if the rates go down by 0.25%, you can refinance. But once you pay points, all that money will be lost, and you won't be able to recover anything for the points that you paid when the rates go down in market. So always focus on the closing cost. So we are still able to offer, even today, we are able to offer 30 years with 0 points, but you have to pay the closing cost for 30 years. Whereas for 15, there are 3% with 0 points. Here for 15, there is no option to get a zero closing cost, but say if someone is paying 4%, they're getting 1% savings, and their loan balance is about 400,000. So basically, in 1 year, they will break even on the cost that they paid upfront, and then that's when they'll start seeing savings on the interest that they're paying. But again, if someone is planning to stay in the house for at least few years, then yeah, then you can think about going for 15 and paying the closing costs. If not, just to be on the safe side, you can go for 30 years, pay 3.5 with zero cost, and still have some savings, 0.5%, right? 0.5% savings is not bad. If your loan amount is like 400,000, 0.5% is about $2,000 per year. And in the beginning years, that means you are saving about $160 or $2,000 per year in the beginning years. Over a period of time, the savings will slow down, right? I mean, fade away over the period of the life of the loan. But you will still have some savings. So I would say, always go for an option, if possible, go for zero closing cost and have as much as savings as possible upfront on your mortgages. And improve your cash flow, try to conserve, have a rainy day fund or do something like that. So this is a list of all the services that we provide. We do all type of loans except HELOCs. We have purchase, refinance, and cash out loans. For most of the products, we have no closing costs and no point options, and lender credit covering all closing cost options. And also, I want to cover on the credit scores. Most of the time, for 30 years, you need about 740 plus credit score to get a good interest rate for a 30-year mortgage. Whereas for 15, most of our lenders, they can offer, even if someone has 620 plus credit score, they can get a 15-year mortgage with the same rate as someone who has a 800 plus credit score. So again, the key is not many people may be able to qualify for a 15 for the payment that they have to make, because they have to be below 43 to 45% of the debt to income ratio. Say if someone is making about $10,000 per month gross salary, right? And then so that means 4,500 is the maximum amount of monthly payment every month, including all their liabilities. And I say $4,500 max, like it's their mortgage, property tax, insurance, credit card payments, car payments, everything combined. They need to have it under 45% debt to income ratio. So I mean, obviously 15-year payment will be higher. It won't be double when compared to 30 years, but about most of the time about 40% is 40 to 50% higher for a 15-year mortgage when compared to 30-year mortgage. So if someone can afford to make a higher payment to get the lowest possible rate, and even in some cases where they might have a lower credit score, then opt for 15-year term. That's what I would suggest. And also, even the mortgage insurance premiums are also very low when compared to 30-year mortgage options. So, say if someone has a loan amount of 400,000 and 30-year mortgage insurance premium is say $250, right? Whereas if you go for a 15-year mortgage, the mortgage insurance probably is about $100. So there is about $150 savings just on the mortgage insurance when you go from 30 years to 15. And also, interest rate also, if you see a 0.375 or 0.5% difference between 15 and 30, that's another $2,000. So there is huge amount of savings, on the mortgage insurance premium, interest burden for a 15 and 30 years. So always, call me. Feel free to call me if anyone has any questions. I'll be happy to discuss personal details and then advise on a best product. So we do also offer adjustable rate mortgages, but with adjustable rate mortgages, the main disadvantage is borrowers will not get uh, uh, closing cost credit from lenders, because lenders know that borrowers want to refinance again in couple years. uh, so they don't want to spend or offer lender credit to borrowers who are looking for adjustable rate mortgages. But say for example, right now, instead of paying 3.5, and if someone has plans to pay down the mortgage quickly, uh, and want to have manage cash flow, in those scenarios they can go. If they go for a 30-year mortgage, and have a savings of at least uh, half half percent or 0.75%, then they can consider paying the closing cost. See, again, they are only able to recoup their closing cost in about 1.5 years. After that, then they will have savings on the uh, for the cost that they paid for the adjustable rate mortgages. So, factor in all those things. See how long you want to stay in the house, and then decide what is good for your scenario. And we also do commercial mortgages, but mostly we are focused on, the shopping centers and multifamily, where commercial mortgages are a little bit different. I mean, again, I don't know if many of the audience have interest in the commercial mortgages, but we can, uh, uh, you know, go through that topic in detail if a lot of you have interest in that. But in general, I would say, rates right now for commercial mortgages with about 25% down payment are about 4%. We are able to get about 4% for uh, properties with good cash flow. Um, so we are mostly focused on shopping centers for the commercial mortgages, and we do it in all states. And the loan amount has to be minimum of 1 million for commercial mortgages. Anything less than that, uh, we don't do that for commercial mortgages. But whereas for residential, even if the loan amount is 150 or 200,000, we do it. And what we are seeing in this market is jumbo loans. Lenders are not inclined to do much jumbo loans in this market. We are seeing at least 20% down payment requirement. Even then, market is drying up for the jumbo loans. But things change. That's what we are observing right now. But if someone needs uh, for primary residence and looking for higher loan balances, we do have products. We do have lenders. As I mentioned, we deal with a dozen different wholesale lenders, and with one of our lenders, we should be able to find a product that you are looking for. So the main advantage of working with us is, if you go to any other bank or anywhere, right? You talk to someone, and then they pass on you to someone else, and they will take, they may not be responsive, and with us, mainly the main advantage is, I will be your single point of contact. I work with processors in the back end, make sure to take care of the entire process from the start to finish. We're always here available to answer any questions anyone may have. And, I can provide you guidance, uh, on the realtor services too. And most of the clients, are busy during the day, so I am pretty flexible, can work with them based on their schedules. Let's see. Yeah.
Thank you, Mahesh. There are a lot of questions from our group members.
Okay, excellent. Yeah, please.
Yeah.
Where do I see?
The first question is there any website to know interest rates for refinance?
Right now, Not any specific website, but you can reach out to me, and I can give you the current rates. But in general, in the past, we used to monitor, ask borrowers to monitor, if they go onto marketwatch.com, and then they can look for the rates, and in that, you can see 10-year treasuries, where most of the time, mortgage rates fluctuate along with 10-year treasuries. I mean, it has been in the last month and a half or so, it's not following that, but in a stable market, mortgage rates are move in tandem with the 10-year treasury notes. So if the 10-year treasuries go up, we see interest rates going up. If they go down, we see slowly the credit improves, and then the interest rates get updated.
Okay. How difference is good for interest rate versus APR? Why APR is more than interest rate?
See, the main difference is interest rate is the rate that you are paying on the outstanding balance to the lender. Say if your outstanding balance is 100,000, if your interest rate is 4%, that means you're paying 4,000 per annum for the 100,000 balance. But it's calculated on a daily basis. But whereas APR, say if your APR is 4.25%, that means if you're paying a closing cost of say $5,000, the extra $5,000 is amortized over the life of the loan, and then the interest rate is and the APR is calculated. Interest rate will always be the same, 4%, right? But once you spread that $5,000 over the life of the loan, that's when the APR is calculated. So for someone who don't want understand much, and get a clear idea of if they're paying any closing, they always want to see at the once they receive the final closing disclosure, look for if their interest rate and APR are same or less. Your interest rate, if your APR is higher than your interest rate, that means you are paying closing cost. If you can always exclude the prepaid items or the money that you are putting into the escrow account. Those are some of these calculations. They might assume that they are closing costs, but they are not. Actually, it's prepaid money. You have to pay that money anyway, even if you are not going through the refinance process. So excluding those items, if your interest rate and APR are close to each other, then you know that you are not paying much or any closing costs. That's where you can see the difference. And always, interest rate and APR are to be, if you are paying zero closing costs, that means your APR also will be the same as interest rate.
Okay. I have paid 12% of the property cost, still paying mortgage insurance. Is there any possibility to get this avoided?
Well, I mean, there are some lenders who do offer upfront payment for the mortgage insurance and for a little bit higher interest rate. Yes, there are options, but again, you want to look at the overall payment. What happens is lenders have to remove the mortgage insurance once the amount of equity that you have is about 22%. But by law they are supposed to remove it when it reaches 22. But if you want to call the lender, any of these lenders which are basically Fannie and Freddie own mortgages, they can call the lender and ask them to remove the mortgage insurance once you reach 20% equity. Say if you are current yeah, once you reach the 20%, you want to look at the purchase price and look at the loan balance. Say if your uh, purchase price was 500,000 and your current loan balance is 400, you have 20% equity. At that point, you can call the servicer and ask them, can you remove the mortgage insurance? They can do that. But even if you don't call them, once it reaches 22%, it has to be removed by the lender, even if you don't request it. So definitely, I mean, if someone is at 12% and looking for options to reduce their mortgage insurance burden, again, I don't know what their current uh, interest rate is. We can certainly evaluate and look for options where we can reduce the mortgage insurance burden and also the interest rate burden.
Okay.
So,
3.125% for 15 years is my current mortgage. Is it a
uh-huh.
good time to refinance now?
I
Can we
would
get a zero closing cost deal?
no, not right now. With a zero cost, no. If you pay closing costs, it's not worth it. So it may, I mean, unless you are paying mortgage insurance, uh, it may not be a good idea to just see. For your scenario, you need to get at least 2.875 and zero closing costs, which may not be possible in current environment. You know, just hang tight and enjoy the lower rate that you have right.
Okay. Is there a time limit after first refinance to the next one if we want to do? Say, for example, first refinance it to 25 years, and now if we want to refinance to 15 years.
As such, most lenders I mean, especially when you're going through a mortgage broker, they require you to have about 6 months between the refinances. But after, 5, 6 months, there is no restriction as such. If you, even with the same lender, even if you are trying to be within the same term, like if you are at 30 and still want to be within 30, no problem. Or if you want to switch to 20 or 15 or from 15 to 30, no problem, as long as you have 6 months gap. uh, but I mean, if you got a mortgage from the builders most of the time they have a lot of restrictions, and they don't disclose, and they lock in the borrowers to go through them. So in those scenarios, you don't even have to wait for 6 months. Even after a month or two, once you get your first mortgage statement, you can go through the refinance process. But when you're going through the mortgage brokers, they require you to stick with them for 6 months, because most of them, try to pay the closing cost.
Okay, when you say zero closing, is that included in the interest rate?
Yes. Say, in this scenario, today's market, right? 3.25% is the rate where borrower pays zero closing cost and pay the closing cost to get a 3.25 rate. But instead of paying 3.25, if you are paying 3.5%, lender offers like a 1% towards the closing cost, where it covers the closing cost. It's if you started with a $400,000 loan, at the refinance completion of the refinance, your loan balance is still 400,000. But your interest rate, say if you are paying 4%, that reduced to 3.5. So in that scenario, I'm saying, they are paying zero closing cost, have a 0.5% reduction in the interest rate, right? But if they want to get 3.25 and lock the 3.25 for a longer term, they can do that. But I mean, the break-even period is typically about 4 years. So if I mean, someone is planning to stay in the house and want to get the lowest possible rate and stick to it for the next 30 years, then they can go for 3.25 as well, pay the closing costs and recover the closing costs in about 4 years' time.
Will it help paying mortgage payments biweekly? Is it a good option?
Well, some lenders do give that flexibility, but see, one thing everyone has to realize, lenders will charge interest on the outstanding loan amount on a daily basis. Sometimes, it might show up in a monthly calculation, but say if you pay it on the 1st or the 14th or the 18th, you're only paying the interest for the, from that day. Say if you paid like, $200 extra to the lender, you're not paying interest. So if, if some lenders are giving that option, and if you have the flexibility to match it with your pay cycle, then yeah, you can do it. But there is no additional advantage. Someone who is on a monthly payment cycle, and when they have a couple $100 extra and they want to make an extra payment, they can always do that. So it's no different than paying a monthly mortgage payment versus biweekly payment. What I would always caution in that, in someone who is trying to do a biweekly payment, there are some services out there, they charge like $100 or $200 per year just to collect the biweekly payment and then make the payment, based on the uh, lender schedule. In that scenario, I would say no, don't go for that option. I would not pay anything extra just to have the convenience of paying biweekly. You can always do that. Most of the lenders have auto draft feature, or you can pay on demand. So you can just log in and then make a payment, any extra payment that you want to make. So the bottom line is there is no point in making any extra fees or paying any extra fees to have the convenience for a biweekly payment.
I have 7 years ARM for 2.75 percentage and paid some money for points at that time, around 3 years ago. Is it good time for me to lock 30-year rate or stay in 7-year ARM until it expires?
So we are talking about 2.75 and currently 3.25. So about 0.5% you will still save. See, I think if someone has a plan to pay down quite a bit of their loan balance in the next 4 years, then they can continue and get the 2.75. But again, if they are not planning to pay off much, in 4 years interest rate might go up. So again, I don't know their personal situation, if they are planning to pay down quite a bit in the next 4 years. If not, then they and they're trying to keep that loan for the next 30 years or 25 years, they can still, I think 2.75 what they have is a pretty good rate for 30 years. So there is no rush for you to go out and then get a mortgage at 3.25 and again pay closing costs, or take a 3.5. If you go for 3.5, 0.75% you will be losing every year for the next 4 years. So yeah, just call me offline. I can discuss your particular scenario and see if it makes sense to refi. But in general, as I think you have at least 0.5% savings, the fact that you are savvy enough to get the 2.75 and you already paid the points, I would say, just stick to it at least for 2 more years or 1 more year.
Is title insurance mandatory every time we refinance?
Yes, in Texas, it's mandatory. There is a discount offered by the title companies, they need to offer. If the mortgage was originated in the last 4 years, there is a 50% discount to the mortgage, the title insurance premium that the title companies offer. If it is more than 4 years, they get between 4 and 7. They get a 25% reduction to the title insurance premium. But if it is less than 4 years, or if someone refinanced in the last 4 and trying to do it again, then they get a 50% reduction. So yes, it is required, but there is a discount which goes along with the refinance. But someone who is more than 7, 8 years into the mortgage, they may not get any reduction.
My current rate is 3.25 and I want to refinance for 20 years. Can I get 2.75 with zero closing?
No, not right now.
What is the interest rate for 30 years without any closing cost and points?
Right now, what we are seeing is 3.5% for about 350K loan amount. If they have a higher loan amount, they might some get extra credit. But if it is lower loan amount, then they may have to pay some closing costs, but for a typical 350K loan amount, you can expect all the costs to be covered at 3.5%.
We have a question from Mr. Chandra. Chandra, I unmuted you. You can ask the question.
Hello, Mahesh. Thanks for making this. This is Chandra. I live in
I
Houston.
think.
I just purchased a property 4 years ago. I paid 3.5 as a 30 years conventional loan. And
Mhm.
I took like 5% I paid down payment, and I'm
Okay.
paying mortgage insurance still. It's like 4 years now. Overall, I haven't come to 20%. It's only 11 to 12. Is this
Mhm.
time to do refinance to avoid the mortgage insurance?
How much is your mortgage insurance monthly?
I'm paying current now $200 monthly.
200. Okay. Um, yeah, 200. I mean, again, see, based on your monthly payments or, the principal repayment, it might be only 10 or 11%. But do you know if the values, what was I mean, you want to look at your county assessed value and then decide if you have more than 10, 11% equity. Uh, Most likely you will get a better mortgage insurance rate than what you have, the $200. But we have to look at the property and see if it can get appraised for a little bit higher. So if you are in the 5% bracket, right? I mean, so all these mortgage insurance, they go based on, 80 to 85 is one range, 85 to 90, 90 to 95. So you will fall in the 80 to 85 to 90%. But, and in that range for, maybe it will be $100. But if it is below that 82, if you have a little bit more equity, you can bring, after the appraisal, you can always adjust the loan amount during the loan process. And if you want to pay a little bit more to bring your loan to below 85% loan to value ratio, you can do that and reduce the mortgage insurance. So I have some tools available with me where I can check the property's approximate value, and I can advise, But again, at the end of the day, whatever the appraiser gives, that will be the final amount. But we can always try to guesstimate the value of the house and see if it makes sense to refinance.
This rate is a fixed one, right? Basically, the 5% also I was paying 200. Even after paying 12% also, I'm paying the same 200. When I
Exact.
my, when I asked my mortgage company, they said they asked me to pay 20%. If at all I would have 20%, I would have not paid 5%. I would have paid 20% upfront to them. So making no sense. And to one of your point, like I have my appraisal value is 366,000.
Hmm.
My current mortgage is 360,000. So I'm not sure whether that makes sense. Where I'm underwater or what's that?
Yeah, I mean, if you don't have much more than equity, I mean, especially again, I don't know how your county came up with assessed value, but when the regular appraiser does it, they look at it in the sales comps nearby your house in your neighborhood or nearby within a half mile or 1 mile radius, and then they will come up with the value for the house. So as long as you have, uh, say, if the value comes out to it around 400,000, you will have at least 10% equity, and then you can have a reduction. But yeah, the lenders will always try to collect the mortgage insurance premium, which was defined at the time of the loan origination. Not, they won't change or update the mortgage insurance once you sign a note. So the only option is to go through the refinance, but again, you need to have the value, the appraisal value has to come up with at least 10% or, more to have improved mortgage insurance premium.
Okay. So right now it's only way to pay more principal to get it reduced.
Correct. But I mean, if your house value is only 365, then you cannot have a loan amount of more than 280. So that means you have to again come up with about, 60, 70,000. But if the value is 500,000, yeah, most likely you want to do a refinance. But if the value is close to only, uh, appraised value and your loan amount is similar, then you probably are stuck to uh, paying the mortgage insurance until you get to the 20%
Okay.
with the current lender.
Okay. Okay. Thank you. But
Yeah,
one last thing, like we don't have any option to reduce it, right? Unless we refinance with someone else, because my
correct.
this company said they don't have any option for that.
Correct. Anywhere, the only option is to refinance if you want to reduce the mortgage insurance or the interest rate. Even with the same lender, once you sign a note, they probably sold it in the back end, in the market, right? You cannot reduce the interest rate or the mortgage insurance, unless you pay down the principal.
Okay. So it is something like we give in our head, they can say whatever they want.
Well, yeah, at that time, when you originated the loan. But if the value is appreciated, in some areas where I've seen a lot of people have their properties appreciated in the last couple of years, they can take advantage. Now, if the property appreciated to 450, they can get rid of the mortgage insurance, do a refinance, get rid of mortgage insurance.
All right. Okay. Thanks.
Yeah, you're welcome. Kishore?
Yeah. Next question is from Mr. Ravi. He's my good friend, family friend, and also he's like a co-founder for this group. He supports in all managing all the groups. Ravi,
Nice.
ask your question. Hey Ravi.
All right.
It seems he's on mute.
No worries.
Let's go with the next person in meantime. Mr. Satish Das. Hi Satish. Satish, I unmuted you. You can ask your question.
Yeah, hi. Sorry, I was on mute. So
Hi,
my
Satish.
yeah. So Mahesh, I have two questions. First question is the appraised value of the property. Um, is it? I mean, I'm asking with respect to selling. Is it
Mhm.
advisable to protest to lower down the appraised value if the market value is higher and the appraised value is lower with respect to property taxes? Is that recommended to do? If we have an option to lower the appraised value, is that recommended?
Well, yeah, I see your point. I mean, so, again, it depends on the local market where you're trying to sell, right? If it is a strong, seller's market, then, it doesn't matter what the appraised value is from the county. You as a seller has a control on pricing, because there are a lot more buyers in a seller's market. There are a lot more buyers when compared to the houses available in the market. So in that situation, yeah, you may want to go ahead and protest. But if it is a buyer's market where there are a lot of houses for sale, and in that situation, people try to bargain or negotiate, right, to get a lower price. They'll say that, hey, county appraised value is only this much, so there's no point in protesting and reducing your house value uh, if uh, if it's a buyer's market. That's the one question that you had about appraise. I mean, do you want to protest your property taxes or not, right? Does it answer your question, Satish? Yeah. Okay.
Yes, I think.
Yeah. So again, I was on mute. Yeah, that answers me. So
Okay.
it is not advisable every time. Depends upon the market, as you said, buyer or.
Right.
Okay. So my second question is, I actually wanted to get a advice on HELOC. I mean, is that something recommended, or can we use it for our benefit?
HELOC, I mean, obviously, right? I mean, it depends. See, I don't know how much equity you have or not, but anytime you're trying to take a home equity loan, which can be a fixed loan that we can originate, or a HELOC, which any of the local banks can do, but you always need to have at least 20% equity, and you can borrow anything over 20% only. Say if the house value is 500,000, the loan amount, including your line of credit or home equity loan, cannot be more than 400,000. But if your loan balance is 300, you can borrow another 100,000 in HELOC.
Correct.
Yeah, that's what you can do. But HELOC rates, are going to be higher. Like right now, around 4.5%, for definitely north of 4%. But if you are trying to keep the money and invest in for a long period of time, then you can try to go for a fixed cash out loan, where you can get as low as 3.375 with paying closing costs. Nowadays, we are not getting loans where borrowers can get all the closing costs covered, but interest rates are not bad. 3.375 versus 4.5, or 5% for HELOC. So again, it goes back to individual scenario. But in general, yeah, I mean, as long as you are investing the money, trying to use it and making a lot more than what you're paying the bank, better to take out HELOC and home equity, and use it for investment activities.
And I guess we can use HELOC to pay off the mortgage
No.
itself, right?
What is the point? I mean, if the primary loan is say at 3% and you're borrowing it at 4.5 and trying to pay the 3, it doesn't make sense. You want to do it the other way around, which is what you will get a cash out loan and pay off the HELOC, which is at the higher rate, and then reduce or move the higher interest rate balance to the lower interest rate balance.
Yeah, so I actually asked that because, I mean, correct me if I'm wrong. In HELOC, we always pay the interest, right? The principal doesn't kicks in with after certain amount of time,
No,
right?
it doesn't. Say in HELOC again, yeah, you are given an option to only pay the interest portion. It doesn't mean that you cannot pay. Say if your HELOC is 100,000, if you pay $1,000, if the outstanding interest is like $200, the other 800 will go towards the principal. Your loan balance will be 99,200. It's not going to be 100,000. So
Yeah.
anytime, I mean, even if it is a HELOC or home equity or a main mortgage, interest is always calculated only on the outstanding balance. So yeah.
Yeah.
So
True.
I mean, it doesn't matter. I mean, you want to keep the amount at the lowest possible rate in the primary, not on the HELOC where you pay the higher interest rate.
Yes. So if I give you an example, if I suppose if I have 100K balance on my mortgage left, and suppose I have appetite to actually pay off the mortgage of 100K, but I'm not willing because I'll lose my equity. In that case, can I take a HELOC? If I'm taking a HELOC of 100K, paying off the mortgage, and now for 100K HELOC, I'm just paying the interest, and for certain time, and then after a few years, I'm just suppose the interest maybe 300 or 400, I don't know. But because I paid off the mortgage, my monthly mortgage is now reduced to only interest, which is 400 now. And I continue with a few years and then maybe pay off the complete HELOC also.
See, again, you take the HELOC just for the flexibility point of view, right? Someone who has a lot
Just
of,
to have liquidity. Just to have liquidity.
right. HELOC is someone who who has a lot of cash moving around, and they don't want to keep it idle. Then they can try to leverage HELOC. But if you are trying to take it for long term, invest in some real estate, then better to take a fixed rate, pay the lower interest rate.
Okay.
Yeah.
Okay. Thank you,
Okay.
Mahesh.
Yeah, you're welcome.
Now let me unmute Mr. Lokesh. Look. Lokesh, you can ask your question. You are unmuted.
Hello. Hey Mahesh.
Hi, Loki. Yeah.
I have a question regarding the refinance. So I bought a property 2.5 years back, and right now my interest rate is 3.75, and I'm
Mm-hmm.
paying around $110 as a PMI.
Mm-hmm.
So is there any benefit if I go for a refinance for 25
Absolutely.
years, not for 30 years?
Right. See, you can go for 25 or 30, or 20, it's the same interest rate. So for your scenario, if you can get it for 3.5 with zero closing cost, yeah, you have the required minimum 0.25% savings. You can do that. Yes, absolutely. I think, feel free to call me, and, we can, look at the loan amounts and then evaluate the property and see if you are going to have savings on the mortgage insurance portion too. Definitely, you are going to have savings on the interest rate. On top of that, if you are going to have the mortgage insurance savings too, then yeah, it's a no-brainer. You should go through the refi process.
Okay, so the 9718 is the best number to contact you.
Yep, yeah, that's perfect. Yeah, that will
Only on the weekdays, or I can call you tomorrow also.
anytime, weekday, weekend, I'm flexible. Yeah, it's not like 8 to 5 job, but I'm pretty flexible.
But
Work
usually
around.
people will not work on weekdays, so that's that's why I ask you.
I know, but yeah, I'm pretty flexible.
Okay, I will call you. I will call you then. Thank you very much,
Okay.
Mahesh.
Yeah, you're welcome. Yeah.
Yeah, hi Mahesh. Can you hear me?
Yes.
Yeah, Ravi.
Yeah. So this is Ravi. My query is, I spoke with a couple of other lenders also. So my query is, right now I'm having 3.25% rate of interest, and my house value is about 380K, but I'm only looking for 185K, which is my balance. So I'm looking for about 2.75% rate of interest, and everybody are saying you need to wait for few more weeks, because right now you cannot get 2.75 with zero closing. So I'm just asking, like, how I can check, is there any website where I can just see every day how the market is dropping, so that I can directly call them and I can even I can call you, and if you can get that rate with zero closing, or like a nominal closing fee like $600 or $800, I'm okay to pay.
Right. Especially for your scenario where you have a smaller loan amount, right? It's, closing costs are still going to be there. Appraisal, title insurance, escrow fee, underwriting fee. So closing costs are going to be higher. For your scenario, I mean, I'm assuming you have a 15 years term.
Right now I have 30 years for 3.25, but I want for 20 years or 15 years.
Yeah, 15 years, it will be hard to get a zero closing cost. I mean, beginning of March, we were able to do like 2.75 for 15, but not for a loan amount like, below 200. If you have at least like 350, 400, we were able to do it for zero cost. But now, you can't get that low rate and for a small loan amount.
Okay.
So
So
the other part of the question that you were asking, can you monitor it somewhere? Not exactly. You can check on marketwatch.com and
Market Watch.
yeah, marketwatch.com, and then see, I was addressing that earlier also. but there, you can only monitor the 10-year treasuries. In the last month or so, we are not seeing the mortgage rates, exactly moving in tandem with the 10-year treasuries. It might change in the near future, but right now, it's, the only option is to call any of the originators and, get the rate and options that they have.
Okay. So one more question is, in addition to that, is whenever we refinance, are they going to evaluate the house property value, or do I need to pay the appraisal cost of $400 or $300, or not required in my case?
Again, there can some lenders are, there will be options where the appraisal can be waived, but lenders also charge for, waiving the appraisal, property inspection waiver. That's what we call PIW. So in that scenario, I mean, especially when someone has a lot of equity, we may be able to waive that inspection. But again, some lenders do charge to waive the property inspection waiver. So,
Okay.
yeah, it's possible, but we have to look at what is right for your scenario at that time when we are ready to do.
Okay. Got it. Thank you so much.
Yeah, you're welcome.
Thanks, Ravi. Next, Sarvanan, I am unmuting you. Sarvanan, you can ask your question.
Yeah, thanks. Thanks, Magesh, for the brief overview. Magesh, two quick questions. I think HELOC you covered, but I also heard on HELOC there is an option where you can park all your income, and let's say you pay your utility bills, you do your mortgage payments, or whatever you are doing as a spending, even doing it for your credit card, if you park that amount and then spend or pay from that HELOC account. Let's say I have a loan of 500K, and if I take a HELOC for 500 and I park 100K, for that 100K, you don't need to pay interest as long as that 100K is there. And if you are going to pay for the remaining 400K, your equity gets built and you can use that amount. Do you have any banks or do you do anything of that sort? Because I came across this very interesting scenario, and not much of lenders have complete insight on this one.
Right. See, HELOCs are, a good option only if you have a lot of equity, but they don't do 100%, right? The max that they can go is 80%. Also, you have to realize if the HELOC interest rate is higher, there is no point in going. Say if the HELOC interest rate is lower than the fixed interest rate, yes, what you are saying makes sense. But when the fixed 30-year fixed rate is 3.5 and the HELOC is at like 5%, you're paying higher interest rate to take the advantage of having the HELOC at the flexibility. So, in this scenario, like if you're instead of paying the 3.5 for the 500,000, you're paying 5% for 500,000, which is like 25,000 per year. Here, if it will like it'll be 17,500. So you are going to pay $7,500 more per year for having that flexibility. So if someone has a business and they are going to have a lot of cash flow, and then in those kind of situations, yeah, it might make sense. But for 90% or 99% of the population, when the interest rate fixed rate is lower than the HELOC, it does not make much sense. But you can always have a smaller line, like say, have a 400,000 fixed loan and 100,000 HELOC, and that 100,000, you pay when into that account when you have some cash, and then when you want it, you can take it out. You can try to utilize it that way, but trying to have entire HELOC does not make sense where you pay a higher interest rate.
Okay, thank you. And second question is that, can you explain on 0 points? I was not sure I got my head around it. Can you explain on that?
So basically you pay, points is something you're paying the lender upfront. some money to get a lower interest rate. Say, right now the 30 years par rate is 3.25. Basically, at 3.25, you are not paying anything to the lender to get the 3.25, or you are not getting any credit towards the closing cost. Say instead of 3.25, if you want to get 3.125, right? You may have to pay like 0.5% in points to the lender to get 3.125 rate. So that 0.5% is considered a point of the loan amount. So basically you pay points to get a lower rate. That's the simplest answer.
So in case if I want to pay 0.125% in terms of cash, how much is my savings on a year for 100K, Magesh?
So instead of getting a 3.25, if you go for 3.125 to get that rate for 100,000, you are paying.
It's the other way around. Let's say let's take a average number. Let's say I'm getting a loan amount for 3.5, and if I want to bring it to 3, so 0.5, let's take that so that it is easy for an understanding perspective. Just
Okay, so your current rate is 3.5 and you want to get a 3%. So you are trying to get 0.5% lower on the interest rate. So to get the 0.5% lower on the interest rate, you probably have to pay 2% to the lender to get the 0.5% lower. So that means it takes 4 years for you to recover the money that you paid to the lender in points. And then after 4 years, you will start making money because you got the lower interest rate. But if for some reason, if you sell the house or pay off the loan within 4 years, lender will be in benefit because you already paid interest for the next 4 years to get the lower rate of 3%, right? So 0.5% savings for the next 4 years will be 2%. And you're already paying them 2% upfront to get the rate.
okay. But in terms of 2%, how much would that cost be for 100K?
2% of the loan amount. So if your loan amount is 100,000, you are paying $2,000. 2% of 100,000 is $2,000. You pay lender to save 0.5% in interest, which is like $500 per year. To save that, you pay them $2,000 upfront and get the lower interest rate for 30 years. But for whatever reason, if you sell the house or refinance within the next 4 years, you will lose the money that you paid to them, the 2,000 that you paid.
Okay, so this also goes down in case of the earlier example. If I'm lowering my interest by 0.125%, so it would be $500, which would be a amount. Is that a fair statement? It is proportionate, right?
Yes, it's proportionate.
Okay. Thanks, Magesh. Thanks for your
Sure.
time.
You're welcome.
Yeah. Next one, Mr. Krishna. I unmuted you, Krishna.
Yeah, hello. Hello. Thanks, Kishore. Thank you, Mahesh. And it's very interesting. I have one question. My current interest is 3.5 for 30 years loan, and I paid the 20% equity already, just recently, finished now. Still, I'm paying for the mortgage insurance. Do you want me to talk to them? Because they said 5 years, but I just took a loan 4 years ago. Do you want me to talk to them to reduce that insurance, mortgage insurance?
Right. Unless you reach 22%, they might keep collecting. Some lenders, they want you to go through the appraisal process to remove the mortgage insurance. But once it reaches 22%, they are legally required to remove the mortgage insurance.
Okay. 22%.
Even without appraisal.
Okay. So in this current scenario, should I go down for 30 years again, refinancing, or I should stay with the 3.5 interest rate?
If you already have 3.5, there is no, unless you get a 3.25 with zero cost, there is no point in doing it. Right now, it's the same 3.5. So you are better off. whatever the rate that you have is good. There is no need for you to refi. Basically, that's how I'm looking at it.
Oh, thank you, Mahesh. Thank you.
Sure.
Yeah, next one is Mr. Prudwin. He's also one of our admins who supports in sharing all the information to all our groups. Prudwin.
Hey, thank you, Kishore. Hi, Mahesh. My question is, so is it a good idea to go with the credit unions? Because I see like credit unions like PenFed and DCU, they offer at a lower rate with 0 points and with, I'm not sure about the closing cost, but they offer, PenFed offers it at 2.6 for a 15-year loan, 15-year term.
Right. I mean, see, we beat DCU and PenFed a lot of times. Again, you want to, when you are ready to do it, you want to compare on the same day.
Okay.
And take a decision. But most of the time, the DCU or PenFed, they don't pay for the closing costs. But we do have options where you can get it for 0 cost when you go through mortgage brokers like us. So you want to see, if it makes sense, if you are planning to stay in the house or, keep the mortgage for a very long time, then it might be an option to pay for the closing cost and get a lower rate. If not, go for an option where you can have to pay, you can get it for 0 cost.
Right. So one more question I have is like my current rate which I have is like 2.25. It was like an offer from the builder that if I go with their lender company, I was getting it for 2.25 for the first 2 years. After 2 years, it will jump to 4.25. So do you suggest at this time, is it safe to wait for till the 2-year completes till next March, or is it since we have a lower rate now, so is it okay to borrow at 3.25 or 3.5?
Yeah, see, interest rates are at the historic lows, but this market volatility may be there for the next few, at least 1 or 2 quarters. So if you want to wait,
Okay.
yeah, you can just wait and enjoy the lower rate that you have right now.
Okay.
2.25 is pretty good. Yeah.
Yeah. That's only for the first 2 years. Yeah. Thank you.
Yeah.
Thank you for the suggestion. Yeah.
Sure.
Thank you, Kishore.
Yeah, no problem, Pradwin. Next question by Mr. Kumar. And with this question, we'll end because we already, I know, Mahesh Garu took 30 minutes more than the planned schedule.
No worries. No.
Yeah, Kumar Garu, go ahead with your question. I unmuted you.
Hello, Mahesh Garu.
Hello.
I have 2 quick questions only. First one is, I joined late, maybe you might have covered. I'm closing this month. So I'm still with a double mind whether to back out or go ahead because of current situation. Do you think housing market is going to have correction, or what do you suggest? I'm a first time house buyer. So what is your suggestion or prediction?
Right, but see, the thing is, real estate again is very local. So I may not be able to, specify, address your question explicitly. I don't know your local market. I don't know how, if it was a seller's market or a buyer's market before this, everything started. And it also depends on how much earnest money you have paid to the builder, So you have to look at.
Yeah, maybe this question I'll call you offline. But other question I have is, when you say 0 closing cost, does that include government fee or just excluding that?
See, I'm talking about a typical refinance. Say,
Okay.
400,000 loan, which was originated in the last 2-3 years. and to cover the underwriting fee and appraisal, title insurance, all the fees related to.
How that works for the new loan?
For new construction, the closing costs are going to be higher because you have to pay full title insurance premium. You don't get any discount on that. Say for a $500,000 purchase, you pay anywhere like $3,000 in title insurance premium.
Okay.
But whereas a refinance for a 500,000, if your title insurance premium maximum is 1,500, right? But when you purchase, also you have HOA contribution, deposit, and resale certificate, survey fees, a lot of other extra fees. So for a purchase like 500,000, you can expect anywhere around $7,000 for closing costs. But refinance, maybe 3,700. So almost half. So when I'm saying, lender credit will cover closing costs, I'm referring to the refinance for a typical loan amount.
Got it. Thank you.
Sure.
Yeah, we have one more question by another good friend, Ram Teneti garu. Ram garu, you can.
Thank you so much. Mahesh, thanks for the seminar. Two questions I do have are, I got 3.125, 10-year, and I got about 100K. So I guess based on what you answered before, I can't get anything lower than that, can I?
No, not really. And also, when you have a loan amount of 100,000 or, something below 150, there's no point in going through the refinance, right? Because you will have if you have to pay like $3,000 in closing costs, it will take very long time to recover the money that you pay. So, especially when you have 100,000 or lower, just stick to what you have because there is not much benefit to refinance.
The second follow-up to that is there any point in paying it off? I can pay it off. So the popular wisdom is if I can get a higher interest somewhere else, use the monies somewhere else.
Absolutely.
Is there any good reason to pay off the mortgage?
No, if you can, if your money, if you have 100,000 and sitting in its savings or checking account and earning nothing, then yeah, why not? You can pay off the loan now when you don't need the money, but when you are comfortable and you can make a lot more money through investment activities when it's the right time. That at that time you can have to go for a cash out loan and then pay a higher interest rate. But again, the bottom line is your money sitting idle in a checking account or using it for investment activities. If you are using it for investment activities, then no, don't pay off the loan.
Right. So I'm sorry, you probably answered this 100 times. Just one more time. What is the cash out loan again?
Cash out loan is something you take equity. Say your for example, house value is 500,000 and your loan balance is 100,000, right? So that means you have an equity of $400,000, right? So when you want to take a cash out, you can go up to 80% on a primary residence. So in this example, you can take a loan of cash out loan for up to 400,000 for a house valued at 500,000. So when you take a cash out loan at 400, basically the previous loan that you have, 100,000, you will pay off that, and then the 300,000 will be paid to the borrower, which you can use it for investment activities. So that's considered a cash out loan.
Got it. Okay, sounds good. And that's different from a HELOC, right?
HELOC is something basically in this scenario, right? So what they do is instead of you taking the entire 300,000 out at the same time, you borrow, you get a line for 300,000.
What is Ashi? What is the thing? What is the thing?
So in that 300,000, right? So what you do is only when you use the money, you will pay the interest. If you don't use, you just have the line sitting there. And again, HELOCs will have a higher interest rate, like 4.5% or 5%. Whereas the fixed term is like, say right now it's, 3.375, 3.5%. So interest rate difference is there. If when do you want to invest the money? I mean, also there are some restrictions where you cannot do more than one cash out refinance in Texas per year. There is a restriction.
Got it. Thank you, Mahesh. I appreciate it.
Sure.
Kishore, thank you so much.
You're welcome. Yeah.
No problem,
So Mahesh garu, one quick question. This is a very easy question. Like you do refinance a new loan only in Texas or all over US?
For residential, we are doing it only in Texas. We do provide realtor services for new construction all over Texas. And for mortgages, we can do cash out, refinance or purchase mortgage in Texas. But for commercial, we can do it all over the country, but the minimum loan amount is 1 million plus.
Okay, thank you. That's it.
One final question. We'll not take any more questions after this. Mr. Balaji.
Yeah.
Yeah, hi Balaji. You can ask your last question for tonight.
Okay, it may be a very simple question. So this is Balaji from California Bay Area. So question is pertinent. Like my current loan is 7/1 ARM with 3.375. So with the obviously jumbo loan from California Bay Area, right? So
right.
Yeah. Do you think it's a good time or like to go 30-year? I mean, obviously, I don't have any plans to pay off with 7/1. Maybe it's a good time to go 30-year fixed.
Yeah, I mean, just talk to one of the, mortgage brokers or, your current lender or like, who can offer you with a similar rate like what you have. If you can get similar to what you have, then locking it for the next 30 is probably a better option. Even if you have to pay like 0.125% higher, having a fixed mortgage is a better option when compared to having an adjustable rate mortgage. Because you will probably have to, will end up having to refinance in, few years, and the rates might be higher. So, I would take this opportunity and get a fixed rate if it's similar or comparable to what I have right now.
Okay. But you only, yes, you said you are only servicing in Texas area, so
yes.
Okay. But anyways, I think it's a good suggestion. Thanks, Maggie. Thanks a lot.
Yeah, you're welcome. Yeah.
So thanks again, Mahesh Garu, for patiently answering all the questions from all the members.
Anytime.
1 hour session went nearly 1 hour 45 minutes, and still over 50 plus or still 200 plus families joined, and so that's a great session. Thanks for your time, and thanks everyone for joining this evening.
Thank you, and it was nice speaking with you all. And anytime, if you have any questions, feel free to call me. I'll be happy to address anything that I can share my wisdom.
Cool. Thank you.
Right?
Thank you very much.
Thank you so much, Mahesh.
Yeah. Welcome.
Bye, everyone. Good night.
Bye. Good night.
Yeah. Good night, guys. Bye.